Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We've been gone for a few weeks. We're back. We're really happy to be back here, helping you try to improve your retirement, at least financially. We like to talk about, asset management, retirement planning, tax planning and retirement. And, whether you're retired already or you're looking forward to retirement, a lot of the things we talk about apply to both groups. So we answer questions on this show is kind of how we educate the audience, so to speak. So feel free to send in questions here live during the show. We'd be happy to try to answer them. And you can also send them into the email address here for us to look at, or on chat, right? Either one will work. Send it to the email address during the week if you'd like us to do some more research on the question that you have. And then, of course, we've created this channel because we feel like there's kind of a deficit of knowledge base in the area of what to do financially in retirement specifically. So this channel has over 1,500 videos on it. You can go to, subscribe to the channel so that you can get back to it, and you can hit the little bell button to get notified when we put out new content. And then, of course, if you'd like to just, meet with us one-on-one and ask us some questions for your custom, answers and such too, then you can book an appointment with Ethan and I. You go to our website. The link for our website's on the channel here. Up in the corner is a button, looks just like that. Push the button. Our schedule's, online. Set up a 30-minute time with phone, or come in live or do a video, whatever you'd like. You can choose, and we'll meet with you and answer your questions directly. So, looking forward to today's show. I've had a little layoff. Really excited about getting back into this too. So, I always like to start off the show with a summary of what's been happening this week. And it's been a pretty exciting week, actually. So let me discuss that. All right, so this is going back to 2019. This is weekly data chart, which just means that every point on this chart is the end of a week, and they kind of draw the line between that. So we can see the big drop off for the pandemic, and then the big run up after all the money was pushed out, which caused inflation, which created that downturn in 2022, 28% altogether from high to low. But since October 13 of 2022, when we hit our bottom there, we've been going up, right? Mm-hmm. And we're in a primary uptrend. On a weekly basis, daily, you name it, we're moving along very nicely here. And if you look at what's been happening most recently, we had that little dip in April, kind of the whole month of April pretty much went down, right? And then all of a sudden May comes around and we take off. It's kind of interesting because May is, there's this saying, sell in May and go away and, come back in November. Shouldn't have done that this year because it worked out to be the opposite. And June isn't always the strongest month. We'll talk about that in a minute too, but it's still doing really well. And this week we've hit 4 consecutive all-time highs in a row. I don't know that we'll do it today. We were down a little bit when the show started. However, we have been getting some rallies right at the end of the day, so we could still get there today. So there's a lot of factors coming in to drive the market right now. And inflation is coming down. The Federal Reserve is starting to say the right things and show the right things, in their steep statement of economic projection. We have, the pent-up demand coming, and of course we have this artificial intelligence. And it's the artificial intelligence piece is kind of like the fuel on the fire. It's really, and that's, if you look at this run that we've had, if you take out the April drop there, it's been an unbelievable run. I mean, really strong. We're up, over 14% so far for the year. And so a big chunk of that is because of the excitement about artificial intelligence. Adobe was kind of waffling along so far this year. They've reported earnings, and their earnings report had highlighted, how much more money they were making off the artificial intelligence space. And their stock is up. I think today it was up about 15%. So that's a big driver. We're even seeing that with Apple. Apple's seen as kind of a sneaky, artificial intelligence play. And it was kind of waffling along too, and now it's hit an all-time high for itself, and so things are moving. Of course, we all know about NVIDIA as far as that goes, but we put together a little chart here to try to maybe we can move that. There we go. We put together a little chart here to try to show kind of the primary trend. So the top chart is just looking at the S&P 500 in different time frames. So if you look at an hourly data chart or daily, weekly, monthly, right? What's the primary trend? Is it up, which is green, or down, which is red? And so right now the S&P 500 is green on all 4 categories, right? And so, we'll watch the hourly. We use the hourly for like when new money comes in. We'll wait till the hourly turns green before we buy. because all big downturns will start with a downturn in the hourly,
Mhm.
but not all downturns in the hourly will turn into a big downturn, right?
Yep.
Most of them don't. And we're really more concerned with, actually the weekly data, when we're looking at things on a more, consistent basis. But we also have kind of an interest in looking at what's happening across the broad market as far as that goes. So we picked, 8 different funds. We've gathered this. There's a newsletter that we follow, and we've added a couple different ones that we follow, and such too. But so the first one is Vanguard Total Stock Market Index. That's a really broad index.
Yeah, that's essentially a U.S. market.
Yeah, I think it's 99% of the stocks, 4,300 and some odd stocks. So it's a great one. It's green. The Vanguard S&P 500, okay, that's green. We can see that above. This is all on weekly data. We're looking for kind of a more sustainable trend situation in this case. The Dow, which it only has 30 stocks, but it can go different directions, so we like that. That's green. QQQ is the top 100 stocks on the NASDAQ, right? And so really all the big tech companies fit in that category too. And there's some overlap here, obviously, but it's green. Then we have the Russell 2000, okay? So the Russell 3000 is sort of like the Vanguard Total Stock Market Index. Not quite as broad, but it's very broad. It covers most of the U.S. stock market. And what they do there is they take the smallest 2,000 out of that. And so that's considered kind of the benchmark for small cap stocks, right? I mean, we see that all the time. And of course, we have the semiconductor, which is a big component of our economy, actually, especially at this point in time. Utilities, right? All of those are green right now. All right. So if you've got 5 or 6 that are green, you're doing really well. When you're at 7 and 8, it's a bull market, right? And then utilities, sorry, the last one is transportation, which is red right now. Now, in the whole concept of Dow theory, transportation is actually a really important component for a future look for what might be happening. And so the fact that transportation on a weekly basis is, and it just actually triggered this week, is in a negative trend, a primary downtrend. It's something to watch for. But with all the other pieces being green, I think that kind of overwhelms the situation. And still, things look really good as far as that goes. So again, remember that the stock market is a leading indicator for the economy. It's not the opposite. Okay, people get that backwards all the time. They say, why is the stock market going up and the economy's not doing well? I remember my grandmother asked me that once. She says, people are getting laid off and the stock market's going up. And I said, because the stock market is seeing a brighter future. And it turned out to be accurate. And the S&P 500 is actually one of the 10 leading economic indicators that is in the leading economic indicators called LEI. That's very heavily followed. And so of all the indicators out there, it's one of them that's in there. And so, again, if you see the stock market, doing this and it's going up, expect that the economy will continue to do well for the next 3 to 18 months, right? I mean, that's just the way it is. Now, one thing that always breaks down all of these like indicators and what have you is something completely unusual that happens. And so, for example, you can have some kind of supply shocks or different, war situations where it captures, something that's very important to the world's economy, oil prices, those types of things. So those are always there. I always call them the outside influence. So you can look at all of the indicators, you can see all this green, and there's still a possibility that can turn around.
Yeah, your black swan events can trigger massive outflows.
Yes, exactly. Something that's just not Lehman Brothers failing. Okay, this is a company that had been around for 100 years. That wasn't expected at all, and we were already in a soft market standpoint. The market was down about 20%. We fell 30% more right after Lehman Brothers fell in 2008. So those are the types of things that are possible. Like he says, the black swan events. But barring that, right now, the market is in a really good spot, and it continues to have momentum and should continue upward as far as that goes, just because of this momentum is so high. Essentially, momentum is about a body in motion stays in motion. From a scientific standpoint, it's not exactly a body, but it's the concept, and it really applies. I think we use momentum a lot here, but I think it applies quite well to the stock market, in my opinion. So this week was kind of, inflation week. Last week was labor week, which, by the way, last week, the labor numbers came out softer one after another until Friday,
Yeah,
right? So we had less open jobs, we had more first-time unemployment claims, and lower private payrolls, right? And then Friday, we had a pretty big number, 272,000 new jobs created, 180,000 was expected, right? So, to me, that's a good thing. We got a little bit of softening, but then still a lot of jobs created because you need to have new people coming into the workforce to fight inflation. Because most of the supply shock is coming on the service side. Service requires people. And that's where we're getting, more and more people into the workforce. And so this is the consumer price index. This is the core index. This takes out food and energy. The Fed looks at core more than overall inflation because they feel like they don't have as much control over the food and energy component, especially the energy. However, they also look at mostly the PCE index, which is going to come out later, right? Yeah. And so we had consumer price index came out on a surprise side to the low, right? So we're at 3.4% right now. The Fed needs to get to 2%, but again, that's on PCE. So we'll be talking about PCE in 10 days or so when it comes out at the end of the month. The PPI index, which is the wholesale inflation index, came out this week also. That was lower than expected. Matter of fact, it actually dropped.
Yeah, it was negative, which was very surprising.
Yeah, it was supposed to, be up, I think, 0.1%, and ended up down 0.2% month over month. And PPI is somewhat important because theoretically, wholesale inflation leads retail inflation. If prices are going down on a wholesale basis, that might lead to, doesn't always have to, but it might lead to, lower inflation on the retail side. So that was important. And then, of course, the Federal Reserve, this was all on Wednesday. And so we ended up, 0.85% up on Wednesday. Was actually up more, like 1.25% after the CPI came out in the morning. And then after the Q&A session with Chairman Powell, it was down to 0.85, but still pretty good. The Fed doesn't have any real, I watched that session as usual. I wouldn't say it was particularly negative, but, they don't have any real skin in the game of trying to make the market go up, right? Yeah. Sometimes they do when they feel like things are getting too soft, because I felt like at the end of last year, the very beginning of this year, before we started getting the inflation reports, we were starting to see inflation annualizing out below 2% for the third quarter, fourth quarter. And I think they were talking very nicely, and the market started taking off at the end of October, partly because that helps them to not have to lower rates. They don't want to go below 2, right? And then all of a sudden, we got fairly hot reports coming out in the first quarter. They started getting a bit more aggressive on the negative side. So, but this is what's called the dot plot. And I apologize, this is very difficult to see, but just kind of concentrate on the trend, okay? The first column out there, the farthest away from us, is these are the 19 Fed governors that are on the FOMC, and they get a chance to project what they think interest rates are going to be at the end of 2025, 26, 27 in this particular case. 24, 25, 26. And so for this year, there's 4 Fed governors, you can see those 4 dots at the top, that are expecting the rates to stay the same. 7 are expecting it to go down 1/4 point, and 8 are expecting it to go down 0.5%, right? And so that's good, right? That's fine. That's a little bit lower than it was in March when they put this out. It was a consensus around 3 rate cuts instead of this maybe 1.5 on this as far as that goes. But when you look at the next year, right, it's down lower. The next year they're projecting lower. Long term, even lower than that, right?
Yeah, it's kind of stagnating after.
It's always kind of funny to see those little outliers up there. I mean, there's one governor who thinks that rates won't change next year either, right? Yeah, so they're always out there. It's probably the one they interview all the time when they want the market to come down. So anyway, that dot plot only comes out 4 times a year. Kind of on a calendar basis, on a quarterly basis. March, June, they'll come out again in September. There'll be another one in December. This is somewhat important because it just shows, the thought process of the Federal Reserve as a whole. Where do they think things are going? The market has its own guesses, right? Yeah. The futures market will take a look. So the future market is expecting 2 rate cuts, one in September, one at the end of the year. The Federal Reserve is leaning a little bit more towards 1 rate cut, on a consensus basis. So now the Federal Reserve has 2 mandates, all right? So when full employment, which they consider to be 4% employment, unemployment or better, right? It's at 4% right now. So right at the edge of what they consider full employment. It was at 3.4%. So we've actually, that's a fair big number, right? You come up 0.6%, really just in, I don't know, what was that, about 8-9 months or something like that. And so that's starting to capture the Fed's attention, because when inflation was really high, back in 2022, they were really focused on inflation, not so much on the labor market. And so now they're having to look at both and to meet their mandate. And I'd say inflation is a bit more sticky, but the employment picture is getting a bit softer. And so there's probably a little bit of that in play here for when they might lower rates. And we might even want to be focusing more on what's happening in the jobs market as a whole to see what the Fed's going to do, because I think that's going to be the flip side of this. Maybe inflation. The Cleveland Fed president was on Bloomberg Radio today, and her process was they don't see inflation on the PCE core getting back down to 2% until 2026, at least at the Cleveland Fed. And they're actually one of the big projection Federal Reserves. They do a lot of good work. And so maybe they won't be responding to the inflation as much as they might be responding to the labor market. And so I think that's pretty interesting. And then just, from an average standpoint on a monthly basis, a couple things are going on. So this just shows like how many, this is since 2004 to 2023, January through December. How many of the months on a percentage basis are up, So you look at that, the biggest months in terms of positive returns are April and November, followed up by May and July, right? But then you can look at, hopefully you can see this, the bottom number in terms of like what you actually make on average. And this is the S&P 500. So the biggest one is November, right? And an election year, November is very good historically. It doesn't even matter who wins. What happens, in my opinion, is the market kind of holds back. September, October doesn't really move. We see that all the time, right? Like this week, the market didn't move that much Monday, Tuesday, because we were expecting the CPI and the Federal Reserve on Wednesday, and then boom, it moves, right? Just because it's a known. Same thing happens to the election, in my opinion. You might see some softness September, October, and then the election happens, and really no matter who wins, generally speaking, the market now has a known. It's known, and it likes that, and it moves forward. And so anyway, November can be a really good month, and especially in an election year. Now, the next best month on a rate of return is July at 2.4% average. So July is quite interesting. The best 2 weeks of the year, going back to 1928, is the beginning of July. And the reason being is because we have so much money in these big passive index funds now that it's kind of dominating the market. And there's a projection for $26 billion coming into the market in that 2 week period, mainly because that is the end of a quarter and the end of a semi-annual. It's the end of a 6 month, right? And so both of those come in. So some of these things rebalance every 6 months, some of them rebalance every quarter, but they're both rebalancing, at the beginning of July. And so the rate of return has been quite good in July. Now you can see here that it gets kind of soft in the summer. And last year we peaked out at the end of July, the very last day.
Yeah, there's 3 months down.
Yeah, 10% down. So you can kind of see that in the seasonal data. That's true historically, right? So, hey, it might happen again. That's okay. We had a 10% downturn last year. I keep saying this, and we were still up, 24, 26%, depending on how you look at what the dividends or total return. So still, turned out to be a great year. You can have downturns. Matter of fact, I think downturns are important. If you look at that downturn, that's exactly what I was talking about. That comes down, and then people start to buy, and all these people shorted the market because they're figuring the market's going to fall apart, and the short guys have to start buying, and then boom, you have an 8.9% jump in November, right? And so that's why you got to hang in there. You really got to watch the primary trend, because that had not broken primary trend up, even though it was down 10%. Got to hang in there and, suffer through those downturns, and just maybe, tell yourself, hey, a 5, 10, even a 15% downturn could be really healthy for the market. And look at what's happened. We've really run from that going forward. So, This is a great time to be an investor right now. Things are going well. The possibility of rate cuts, inflation coming down, the pent-up demand, the artificial intelligence, all of these things are driving the market right now. And we're really not that stretched out, especially on a PE ratio. Matter of fact, I think we're in the early beginnings of what could be happening here, especially with the artificial intelligence standpoint. Again, there's always that outside influence and always that thing that can happen that can change kind of the whole picture really quickly. But we don't have a lot of control over that, so you kind of keep going with what you've got. And right now, this is a good place to be. And so anyway, that's what's happening this week. Appreciate you joining us for the summary. Hopefully, you'll be able to join us again next week too. So let's cut into our first question.
Why is the Federal Reserve projecting one rate cut when they project inflation and unemployment to be stagnant for the rest of the year?
Yeah, this is when I was watching the conference, the question A with Chairman Powell. This is one of the questions that came up because if you look at the statement of economic projection, they're expecting unemployment to stay at 4% as a consensus, right? Towards the end by the end of the year, where we're at unemployment 4% right now, no change. They're expecting the PCE core to stay at 2.8. That's exactly where we are right now. So why would you cut rates if everything is still the same? I mean, why wouldn't you cut them now, right? Yeah. Exactly. So it's a good question, and you have to kind of understand what happens and how these rate cuts work, because there's a lag. It depends on what it is and what you're looking at, but the lag is someplace in that 3 to 18 month period. And so what they don't want to do is have this accelerated downturn and inflation starts getting past 2% because they waited too long. So they have to be ahead of the curve. And this is where the Federal Reserve generally messes up. And maybe, honestly, it's just impossible because it's so hard to tell what's going to happen in 3 to 18 months. I mean, we could have a regime change and a situation. We could have a totally different regulatory environment, a tariff environment, and they're starting to lower rates or raise rates in that environment. It's very difficult to tell. So they do have to kind of respond to what's going on. But what they're saying is essentially, hey, we think that we've kept higher for long enough. By the end of this year, we should have at least one rate cut and then continue forward. If you looked at that dot plot, that we did in the summary, for the next year, several more rate cuts actually in 2025, just to make sure that we don't end up with unemployment higher than 4%, and we don't end up with inflation lower than 2%, because that's their dual mandate. So they're thinking ahead. That's why you see the projection for a rate cut going with the projection that nothing's changing by the end of this year. I'd be surprised if nothing changed. I do think we could sneak past, 4% unemployment.
Yeah, it's been steadily climbing for months. So there's nothing slowing it down, really.
Yeah, and this week, the first-time unemployment claims was a 10-month high, right? So, we're starting to see some impact of these big increases in rates and the higher inflation that's making people cut back on their spending. I mean, if you're spending your money on food and gas and you don't have money for these other things, those other things might start to have layoffs, right? And so I think I wouldn't be surprised to see also inflation a bit lower than their projection at 2.8% also by the end of the year, pretty much for the same reasons. I think we're starting to see some impact. We did have a hot first quarter for inflation on a relative basis, but we've had 2 good months now in a row. I think they're waiting for maybe another 2 good months, and then they're going to do a rate cut. I wouldn't be surprised if we do get 2 good months again, if they're not doing a rate cut in September. The Cleveland Fed governor that was being interviewed on Bloomberg was really interesting. She says, look, I've been in 200 FOMC meetings, during my career. And she said, not once is politics considered. Now, whether that's completely true or not, I don't know. It does seem to be, a little bit reluctant to do rate cuts before an election. But she says they're really just looking at the data and they want to make sure that they're meeting their dual mandate of, 2% inflation and 4% or less of unemployment. So that's where a September rate cut could happen if that's true. And the market is expecting, I think it's at 65% right now, a September rate cut of 0.25%. So we'll see how that plays out. But I think, it could be two then. If they do one in September, they could quite easily do another one in December or something like that. Again, barring inflation picking up and that type of stuff. Inflation's a little bit seasonal. The summertime sometimes goes up a bit, at least top line inflation, because gas often goes up, that kind of stuff. So we'll see how that plays out. But it's a really good question. I think it's very interesting. All right.
So my portfolio swings are starting to cause me to worry. Is it time to start to think about changing the allocation of equities versus bonds? I see the percentage change and it's manageable, but when I actually see the dollar change, that's when I start to worry.
Yeah, I always like to say you don't eat percentages,
Yeah.
you eat with dollars. And so, a matter of fact, we have a company called Nitrogen that comes in and analyzes our portfolio, sends out a report every quarter, and it shows people, 95% probability that you'll be between this negative and this positive over the next 6 months. And they do a great job with it. They put down the percentage, but they also put down the dollar amount. So they're looking at your account and they're saying, hey, you have X amount, and this percent down means this much is going to be lost. On the extreme case, they show 95% probability. You're probably going to be someplace in the middle of that range, most likely. But and I always get people to look at that dollar amount, because you're right. It's like, okay, I'm down 5%, but it's 185,000. Oh, okay. That's a totally different outlook.
Yeah, and especially as your assets grow, these swings, they're a lot bigger numbers.
Yeah.
And so like as a younger investor, 5% down is only a couple thousand. You're okay with that run because,
Right.
But when it starts to be years of pay in a swing, it can be very scary.
That's exactly right. I've had that comment from several of my retired clients. It's like, wow, I just made or lost, more in a short period of time than I made in my last year of my career with this portfolio. That's actually a good thing in a way. It means that you've got enough money in there, However, getting back to the question, it's a really important question, because in the end, we can do a financial plan to figure out what risk you should be taking in order to meet your needs, right? How much, and that risk really revolves around how much money you should have in the stock market versus how much money you would have in the bond or cash market, right? And that's it. I mean, that's the big issue. So should you be 10% stock, 50%, 80%, whatever it is. But in the end, when everything's falling apart, and one of the things we learned in 2008, it doesn't matter what your plan says.
Yep.
Nobody cares. When your account's down 20, 30%, 40%, whatever it might be, you're going to hit a panic button. And that's why I do think that like this nitrogen thing that we put out allows people to kind of see, they've been telling me month after month after month I could be down this much at some point in time. And so two things happen with that, I hope. Number one is, I use this analogy all the time, but I'll keep using it because I think it's great. If you're walking down a dark, street and there's a big hedge and somebody jumps out from behind that hedge, you're going to be afraid, right? Your adrenaline's going to go up and what have you. But if you're walking down that same street and somebody's going to jump out from behind that hedge. And so I think that's what this nitrogen port hopefully does for the clients. They know, I'm down X a dollar amount. I don't like it, but I knew it was possible, right? Yeah. However, if somebody comes to me and says, hey, I'm nervous about even the smaller swings, not the bigger ones, they're probably in the wrong portfolio, right? And we need to take a look at that and back them off, because they're almost certainly going to bail out at the wrong time. And that's one of the things I learned the hard way in 2008. We didn't have the measures in place to really let people understand what they could lose in their portfolio, in that bad black swan event or whatever it is. And so you get people that then are panicking at the bottom, and it's just the worst time to get out. And so that person that comes to me that says, hey, I'm nervous about this, or it's dropped this much, maybe in April when the market dropped 5%, they're probably in the wrong portfolio, and we probably need to adjust that back down to, or at least, investigate and really find out what that means. And because things change for people. Your risk tolerance is fairly stable, but not completely stable, because you maybe you lost your job, or you have these other situations that have happened, or some huge expense came through. You had to get a new foundation, and so you're feeling like tight and nervous about your finances, and then the market drops 5% and you're down, whatever, 100,000 or something, and that's all of a sudden, your risk is, your heart rate's going up, and you probably need to back off and be in a lighter portfolio. So I would be talking to that person and trying to figure out what's going on and whether we need to move down. We don't have a commission transaction cost anymore with these exchange traded funds, so it's pretty easy to move down. Sometimes, if a lot of big taxable gains are there, it can be difficult. But maybe they have an IRA we can overweight into the bond side to kind of compensate for the non-IRA. We've got a few things that we might be able to do to kind of bring that percentage back down to something that works for them. But we try really hard to show how much you could lose. That's what I talk about in most of my, especially the initial meetings with new clients, right? So anyway, it's a good question, and it's a real life scenario. It's something we deal with on a regular basis.
Why are the first 2 weeks of July so powerful? July for the last 9 years and the S&P has been up, positive.
Yeah, and we talked about this a little bit in the summary for the stock market today. It's a really good question, and it's very fascinating. What's happened is we now have, I've forgotten the exact number, but there's trillions of dollars in these passive investment funds, like these target date funds. And they just keep getting bigger because target date, I don't know, almost every 401k I see coming through is invested in a target date fund.
Yeah, most people just default in a target date. They don't need to think. It's super
Right.
easy and works.
Yeah, I mean, you might have a list of things on your 401k. There's a whole bunch of target date funds. And target date funds basically just, you pick a year out in the future. And what they'll do is they'll say, okay, we're going to be, X amount in stock. And as that year gets closer, we're going to reduce the amount of stock, that type of thing. So the farther out you pick, the more stock you're going to have. If you pick something really close, the more bond you're going to have. So it's kind of easy. But those things get out of balance, right?
Yeah.
And so they rebalance. And then you have these there's a big momentum funds and such, and they'll rebalance once every 6 months. And so if you think about it, once every 6 months is the end of June. Once every quarter is also comes at the end of June.
Yeah, and so
it's the only time that happens.
They're projecting about $26 million.
26 billion.
$1 billion going into equities.
Yeah.
And so it's a large amount of money. And so when you have those massive inflows at a certain period, it just pushes prices up.
Yeah, I saw one analyst call it a wall of money that's coming, and again, the projection is 26 billion. The best rate of return for 2 weeks in the market is the first 2 weeks of July. It does tend to start to soften after the 17th historically, right? And we saw last year it fell down, 10% after the 31st of July. If you look at the historical averages for August, September, October, they're still positive, but they're weaker, right? And we certainly saw that last year. We saw that whole sell-off. Doesn't mean it's going to happen all the time. I've seen some. I remember in 2022 we had a massive run-up that ended August 16th. That was up like 18%. So it's different every year. It kind of depends on what's going on.
Yeah, this year April is usually historically strong.
Right.
This April was pretty weak.
Yeah, exactly right. And it probably has a lot to do with where you are, right, as you're heading into that. So we're already pretty high. We could get higher. It just makes the rubber band stretching out being even more, and that might make some softness through the summer and the early fall. Again, I've been saying this forever. I'm trying to get this through to everybody because there's a way to look at these downturns in a good light, right? I know you don't like to see the statements come in once a month at a lower rate, but it's also very, very healthy for the market. I mean, look what happened last year. Market got down far enough and people started to buy. Bargain hunters came in and started to buy, and all those short sellers had to buy, right? Get to cover their shorts. And we ended up with an 8.9% jump on the S&P 500 in November, which was epically good. It really has kind of started this whole run. So, again, I don't think that happens without that downturn. I don't even know if we're as far up as we are now. I'd rather see things just kind of chunk along slowly but surely. But the market is a representation of human emotion, and we are never in the middle. As a matter of fact, the market hardly ever makes the average rate of return. It always makes something kind of on the extremes on each side. And so, that's a representation of human emotion if I ever saw it. And so, sometimes it just gets fatigued and it's just pushed out too far. It needs to come back. And so, anyway, that I'm okay with what's going to happen in July. I'm excited about it. But we'll see what happens after that.
Does a mortgage or a HELOC, home equity line of credit, lower the capital gains if I sell my house?
Well, that's an interesting question. The answer is no, only because it would be too easy, right? So you've got a giant capital gain. Let's just say it's a 500,000 or $1 million capital gain or something. You would go out and take out a massive mortgage right before you sold the house to get rid of the capital gain. The mortgage brokers would love that law,
Yeah.
that rule, but the IRS doesn't. As a matter of fact, I mean, that's one thing you have to understand about tax law. Even if something is available, often gets closed, right? They're trying real hard to gather money to support, the deficit, what have you. And so sometimes, and that could be true of anything, could be Medicare, and you're, trying to avoid spending all your money for a long-term care scenario. And sometimes there's like a little loophole, and California closed that loophole pretty quick,
Yeah.
and so, there are sometimes loopholes. This is not one of them. The way that capital gains works on a home is kind of fascinating. A lot of people that I talk to still feel like if you go buy another home of equal or greater value, you can kind of roll up your capital gain for later, right? That was a pretty cool law. That's no longer here. Matter of fact, it's been gone for quite a while. I forgot when they changed that, but it was a long time ago. Might have been the 80s, but certainly in the 90s. And so, what happens now is when you sell your house, you get to you don't have to pay taxes on what you paid for it.
Hmm.
You don't have to pay taxes on what you did in improvements.
Yep.
And improvements are a sticky, weird area. You might want to consult your accountant for that. It's not just a normal, hey, I paid for the lawn to be mowed.
Yeah.
It is like, even the basic maintenance, like a roof repair, technically doesn't,
It'd be like I added a pool to
Right.
the house.
Yeah.
I added an extra room.
Yep.
But you got to keep really good records.
Yeah,
Because if
exactly.
you don't have those records, IRS is going to flag you.
Right. So let's say your house is going to sell for $1 million. Let's say you bought it for 250. Let's say you put in 100,000 of improvements. So that 350,000, right? You don't have to pay taxes on.
Yep.
But you still have 650,000 that you could pay taxes on. Now, what they did to make up for not allowing you to roll over the house into a new house is that they gave you an exclusion on your primary residence only, not your other residence, second residence. And so it's 250,000 each. So let's say it's you and your wife. Well, you got $500,000 exclusion, right?
Yep.
And now I had $650,000 gain. That's down to $150,000 gain, right?
It's pretty reasonable when you think about you're making $1 million sale.
Yeah, exactly. Now there's some caveats to this. If your spouse passed away someplace in there, it doesn't really matter what you paid for it anymore. You get a step-up basis to the value at the date of death. That's why it's important to always get an appraisal around the date of death so that you can get that step up. So let's say you paid, $250 for that house that's worth $1 million. Your spouse passed away some years ago, and it's now, it was worth $800,000 when they passed away. You now have a $200,000 gain, but you get a $250,000 exclusion personally. You're single now, and there's no tax on that. Right,
Yeah.
so it's a nice scenario, just in the sense of how it works, but it's important to understand how it works.
Yeah, the exclusion, if you're in the rest of in the Bay Area, it doesn't cover much for a lot of the old people that bought a long time ago.
Yeah.
But if you're in other parts of the country, that 500,000 generally covers majority of that
Yeah.
capital gain.
Yeah, I mean, I think the average house price in the overall country is 384, something in that neighborhood. So if you got a $250,000 exclusion each, there's a lot of the average home is not paying capital gains tax.
Yeah.
We're seeing it here, some big ones. As a matter of fact, to the point where people don't want to sell, just because it's so expensive to
Yeah.
to move someplace else. Anyway, so that's a really good question, though. It's a really fascinating area, just how to calculate that. So I think we have time for one more.
So why do companies split their stocks, and how does it affect their price?
So yeah, that's a good question. Probably revolving around the fact that Nvidia did a 10-for-1 split.
Yeah,
pretty
last Friday.
pretty well, exposed and talked about. I don't. It's kind of funny because in our financial classes and our licensing tests and what have you, they really pound into us that it doesn't matter because if you get 10 for 1 split, great, you get 10 times more shares, but it's only worth a tenth of the cost.
Yep.
But it's whatever reason, and it doesn't matter because, again, the market's a representation of human emotion. Over time, it just, people are excited about it. And the stock generally goes up prior to the split and then also goes up after the split, maybe more than normal. I've seen that over and over. It doesn't matter what company. It's just a thing.
Yeah, the thought process is the company's gone up so much to cause the split, and so
Yeah.
it's going to continue to go up. It's kind of that mindset.
Yeah, exactly. And so, hey, I bought 100 shares and a 10 for 1 split. I now have 1,000 shares. I love having 1,000 shares out. And I don't know, it's like anything else. If enough people believe in it and think about it and think it's exciting, it'll go up. I mean, look at GameStop. I mean, that's what it basically is, right? There's just there's no reason the GameStop should do what it does, but it's just a lot of people jumping on board, the same thing. Splits have a little bit of that going on where people are doing that. Now, there are some reasons that companies do splits. And one of the reasons is, so NVIDIA's at $1,000 and drops down to $100. Is that it allows some platforms you can't buy fractional shares.
Yep.
And so the smaller investors, which have become much more powerful, are much more able to buy that $100 share price if they can't get a fractional share than they can the $1,000 share price. So that's one of the main things you see is these companies. You see these companies. I don't know. For us, it's kind of interesting, and maybe this is a big deal too, is that we can't buy fractional shares on the Schwab platform. Not yet. It's coming, and they're doing some work on that and what have you. But I think eventually you'll be able to buy fractional shares on pretty much everything. But let's say for us, it becomes a problem because we have these portfolios and kind of like a pie chart. And so we have a 3% allocation to one position, and we have a small enough dollar amount, we might not be able to buy one share. If it's $500, $600, $1,000, and I'm talking about exchange traded funds also, but if those exchange traded fund values get so high, and we got a smaller account, and it could be a big client with a lot of money, but they've got a small IRA for, somebody who didn't work that much, whatever it might be, it becomes a real nightmare for us to try to buy that. So we're able to put more money into that ETF if they do a split.
Yeah, it's like the issue with Berkshire Hathaway.
Yeah.
It's like $400,000 more to buy one share.
Yeah.
Not everybody can put $400,000 to one share or one stock.
Yeah, that's right. That's just a pure dollar amount that not a lot of people even have. So yeah, they don't believe in doing splits per se. They do have the B share, which is cheaper, which is interesting. But yeah, it's a good question. It's kind of fascinating. It's being driven. NVIDIA's split is pretty heavily talked about. I got a lot of questions about it too.
Yeah,
so.
it's it's becoming more common. Broadcom is doing it. Chipotle is another company.
Yeah.
There's a lot of companies that once they hit that $1,000+, they really start to think about splits.
Yeah, what was Amazon at 2,000 something last year, I believe it was, and they did a big split. So I like the smaller dollar amounts. It just makes our life easier. For whatever reason, maybe it has a chance to grow faster too. Again, there's just a lot more people that can buy it. It's just supply and demand. You're increasing the number of people that can buy your shares when you do a split.
Yeah.
Period. And so why not? I think more companies should do splits, but it's becoming much more common. So. All right. Well, that's our show for today. I want to thank everybody for coming. Really good questions today. Really enjoyed this. Send in your questions. Send them in next week, today, anytime you want. You can send them to this Ask Tom at talkmoneywithtom.com, and we'll take a look at it and try to answer them on the next show. Really appreciate that. And of course, you can, subscribe to our channel if you'd like. Hit the bell button if you want to get new content. Increase your education around retirement, and you'll have a better financial retirement. Whether you have an advisor or not, the more that you know, the more that you'll probably have, the more that you'll be able to spend, the better your lifestyle financially could be, in my opinion. And so that's what this channel is about. That's what this show is about. And of course, if you want to meet with Ethan and I one-on-one, you go to our website, you hit the book appointment button up in the corner, and our calendar's public. You can pick a time, 30 minutes. You can meet with us in the office, on video, on phone, whatever works for you. So look forward to seeing you again next Friday, and thank you so much for joining us today.